All right. Good afternoon, everybody. Good evening. Um, this is Trading Weekly Options. I am Mark Sebastian. I am the founder of OptionPit.com. I was a market maker for about 10 years. And after I got done market making, I started OptionPit, which is an education and consulting firm. Primarily, we deal with two main areas. We deal with retail traders that are looking to learn to trade like professional traders, and then we do consulting work for institutional clients like hedge funds and asset managers. For a retail client, we'll really teach how to trade, and for an institutional client, we'll go in and test what they're currently doing, help them implement strategies, and we'll try and do quality control and some risk assessment, as well as a few other things here and there. I like to joke that I've had clients that with as little as $1,500 and ones with $15 billion, and the ones with $1,500 usually know more about options than the ones with $15 billion. So that's me, and this is what we're going to learn. What we're going to talk about is how option time value decays, how the pricing model breaks. We're going to talk about the advantages of using weekly options, some of the disadvantages, strategic use, and basic ways that we might use them as a directional spread, and then an example of a trade I might use at OptionPit. All right. So for starters, options are just another form of insurance. All right, that is what they represent. And as with all policies, as time passes, insurance policies lose value. Even on the last week, insurance policies still have a lot of theoretical value that kind of disappears in the last minute. All right. Much like insurance, policies, options decay with the passage of time. And like I said, up to that last minute, that at-the-money option will have value. Going into the final minute, if an option is trading right at the strike price, both the call and put will have somewhere between 10 cents and a quarter, and up to, it can be dollars in a name like Google. And I think a lot of us are probably used to seeing a chart that looks like this, that talks about premium decay. You've got this, you've got this decay that's relatively smooth and then just kind of goes off a cliff. All right, that is a major thing to be aware of. All right, now the question is, so the way we talk about it is at-the-money option premium will decay exponentially. All right, and exponentially is kind of the key word. All right, this is one of the real values of weekly options, is that you get an opportunity to short options at the exponential part of the curve. If you trade weekly options, you're only selling kind of this piece. And you can see that is the steepest part of the curve, which sounds great. All right. So in theory, one should be able to harness lots of premium selling weekly options on a regular basis. All right. And that's especially true with at-the-money options. All right. So now the question begs, is it really that easy? Is it that simple to just, go out and sell weekly options and you'll make bank? Who thinks that's true? I'm sure there are lots of people out there saying it. Yeah, you've got some risk. All right. So there's some important things. All right. The previous chart only applies to at-the-money options. So that at the money option, so a stock that's trading $50, the $50 call and put will have that kind of exponential decay. All right. Now, here's kind of the interesting thing. The further we move from at the money, the more linear decay will be. All right. So the further we move from at the money, the more linear decay is. So if you take a look at kind of an out of the money option, you know, this is that at the money represents, you know, you can see that exponential curve. Notice how out of the money, all right, and then we're talking like, you know, the 30 delta options. All right, notice how these 30 delta options are that's pretty smooth. There's no exponential decay. All right, and so the point is, you know, there's a book by Jim Bittman that kind of discusses linear, you know, the linear nature. For options that are 10% out of the money, they will lose more value from day 30 to from day 60 to day 30 than they will from day 30 to day 0. All right, an option that is 10% out of the money, all right, will lose more money from day 60 to day 30 than day 30 to day 0. So think about it this way. Our $50 stock. So the $50 option, that's the $50 strike has that exponential decay. All right. So this is kind of the $50 option. But what about like the $55 option or the 57.5? What about the? I'll remind me at the end. I'll answer that. All right. Out of the money option, so that 57.5, it's actually losing more value here than this option is losing here. So now, let's talk one more piece of decay. All right, if you were given the chance to flip a coin once, all right, so you can only do it once, all right, and it lands on heads, you get $1 million, all right, and if it lands on tails, you owe $700,000. $700,000. Would you guys take that coin flip if I offered it to you? You only get to do it once. Would you bet $700,000 to win $1 million? If you only got to flip it once. All right, and yeah, neither would I. Most people would not do it. All right, and the reason why is the risk of losing, even though it has a positive expectancy, is too great. All right, now what if you got to do that game 50 times before the side's paid out? So you get to do that coin flip 50 times. Then would you do that trade? Would you do that game? Yeah, absolutely. Absolutely. And so for option traders, this kind of applies to what we call teeny options. All right. Now, what is a teeny option? A teeny option is an option that is worth less than 5 cents. All right. Teeny options will never decay. A 5-cent option takes forever to lose its value. Anybody experienced that? Yeah, it takes forever. So now let's kind of talk about what we've just gone through, and then we're going to apply this to weekly options. All right. So both at the money and out of the money options can decay to a point where they start to act like our coin flip game. All right. While the sale of an option at a nickel may have edge to it and it may have a positive expectancy, all right, because of the risk associated with being short and the margin associated with being short. So if I'm a market maker and I'm short an option worth a penny, all right, a penny. So that option is worth $1. Do you know what the margin requirements are against that $1 option? $25. So I've got an option that is worth $1 that has 25 bucks in risk, in risk margin. So if I'm a market maker and I'm trying to be efficient with my margin, does it sound like I would want to be short or long a option worth $1, especially short? Yeah, so a penny option, they don't want to be short those. So they hold up the value forever. This is kind of a point where the modeling breaks because of the realities of the world. The theory stops working. So this is kind of the way premium kind of decays over the life of an option, even an at the money. So you have this at the money option or an out of the money option, and it has this exponential decay until it gets to about a nickel. And then it starts to slow down again, and it doesn't lose this last penny until like the final day. All right, all this making sense? Good. So now let's circle back to all of this, all right? And we're going to talk about how each of these pieces fit together to form a trade. Each of these pieces fit together to form a trade, all right? So the last week of an option's life has a huge amount of decay at the money. So the decay is fast at the money. Everybody write this down. All right. Out of the money options decay linearly, making this week and last week very similar. So they don't have that same exponential decay. Everybody write that down. And then the last nickel doesn't decay forever. All right, so now let's look at this in kind of a real world trade. This is General Motors. This is last April, all right? So this is the April 10 calls. They have 2 days to expire. All right, the April 10, 36 calls, 2 days to expire. And you can see they're worth 29 cents. Now the May 1s that have 22 days to expire are worth 95 cents. All right, how many times does 2 days go into 22 days? And if you can't answer this, you should stop trading altogether. You stop trading, go back to third grade. All right, so yeah, it goes in 11 times. Now, 11 times 29 cents is like $3.19? So would you rather have $3.19 or 95 cents? Pretty simple, right? Now, the difference is you get a lot more in bulk going with the May 1s, but if you execute the May 10s with precision, you will collect a lot more decay. All right, that's the way to think about it. Now let's look at just out of the money. All right. Now let's look at just out of the money. April regular 37 calls are 14 cents with 9 days to expire. The May 1 regular 37 calls are 51 cents with 22 days to expire. Well, how many times does 9 days go into 22 days? About 2.4 times, 2.5 times? A little less than 2.5. Right? So it's about 2.4. All right? So let's just say 2.5 to round up. All right, now what's 14 times 2.5? About 35 cents. So this weekly option that's just $1 out of the money, if I trade it over and over and over again to expiration, I will only collect 35 cents. Or I can go 22 days out and get 51 cents. What is the better do this time? Kind of interesting, right? How many of you actually would think that an option with essentially a week to go, only a strike out of the money, would collect less premium than an option with 3 weeks to go? Yeah. Bevan, I wear clothes when I sell options. So it's an interest, yeah. So now let's look at the teenies. These are the cheap options. And so here we are, 2 days to go. And remember our option that was worth 14 cents that was $1 out of the money? Well, guess what? It's still worth 3 cents with 2 days to go. These options hang on to a lot of value. A ton of value. All right. Well, I was making light to a question the guy asked. The person asked, "Are we talking about selling naked?" And I just responded that I always wear clothes when I sell things. So there you have it. I mean, we now have kind of seen in a physical manner, all right, cheapy options are terrible to sell. And in fact, they should be closed. And we're going to talk about that some more. All right. At the money options are awesome for weeklies, and out of the money options aren't that great. All right. Anybody here do like weekly strangles or weekly iron condors out of the money, or weekly out of the money credit spreads? If the answer is yes, you are doing it wrong. So now, let's talk about the lesson here. All right. Weeklies are for near the money options. That is where you will make the most money harnessing weeklies. All right. If you are selling out of the money options, you are giving away dollars. All right. And then these little teeny options. Anybody here, do we have any people that habitually don't like to close trades because they don't want to pay the commission on cheap options? All right. Now, if you are one of those people and you are a roller, so if you are the type of person that then waits for it to expire and then goes out and sells it a similar option the following week, all right, because that little piece of decay takes forever to go away. All right, guys, so the question is, with at the money and in the money, are you much more likely to be assigned? You shouldn't worry about assignment. All right, you close things before they end up in the money. All right, now, I mean, I think in my lifetime as a directional, more retail trader, I've been assigned in 2 or 3 times. All right, now, if you are a person that trades these cheap options, go out and close that cheap option, because, as we stated, you will actually make more money closing that 3-cent option and rolling it back to, you know, the April 24s or the Mays. All right. So it's important. If you are not a person who closes options, you are leaving money on the table. If you are a person who closes, you know, fails to close, then goes out and sells the following week, you are leaving so much money on the table, so much more money than you are saving by failing to close those options and collect commission. Plus, you're leaving yourself open a short option that has a serious risk of blowing you up, or killing all your profit. It can happen. Now, let's talk about the benefits and positives of weekly options. So, should one always sell weekly options when one is trading near the money? What about covered calls and cash secured puts? There is a trade-off, and it can be costly. All right, in return for the extra premium, the trader is taking on more price movement exposure. All right, so you're getting lots of premium in, but you've got this price movement exposure, otherwise known as gamma, to professionals. All right. Thus, if all goes right, a trader will make more money selling 4 at-the-money covered calls than 1 monthly. However, what if the underlying really starts to move? Then you got problems. All right, so because the monthly has much more raw premium, all right, one may be able to wait out a pop in the underlying, an increase in the underlying. All right, the weekly just expires and may take one stock away, if not bought back. Or worse, you cover and then the underlying drops again. So generally speaking, I point weeklies toward more seasoned traders or more active traders, traders that have the time to trade all of this, to actually watch and trade this stuff. All right. So because the gamma, it exacerbates the need to close worthless options. So generally speaking, there is edge in selling just out of the money weeklies in really close out of the money. All right, generally, and hedging them with further out of the money options. All right, because of the hyper decay of near the money options and the linear decay of out of the money options, credit spreads in weekly options can make a ton of sense if you put them really near the money. All right, the options should have some teeth, but should not be hyper. So I don't like using weeklies in names like Google or Amazon or things like that. I like them in names that maybe have a little bit of movement but aren't crazy. So one name I looked at was kind of like IBM isn't terrible. There are all kinds of names where there is some premium, but they're not just nutbags. All right, stay away from those types of names. All right, so options should have some teeth but not be hyper. So now let's look at two trades. So this is the July 31, so it's expiring. It expired on Friday. Oh no, it expires this Friday, excuse me. All right, the July 31, 160.65 call spread. All right, now the second one is 160.65. It is the August regular. So same trade, but it's August. All right, someone said close to at the money or low probability, 50-50. Not really, all right, because that's why you're getting so much premium. All right, and you know this can work well for on the put spreads as well. You know, that's why, you know, I think weekly option traders should be able to handle, you know, near the money spreads that do have some potential teeth to them. All right. They should be able to wash, but so, because like, take a look. All right. The July 31, so the one expiring Friday, I have worth about, let's call it 35. We'll call it 133, and we'll call this option 18 cents just to make my life easier. So the July expiring Friday 60-65 call spread is worth $1.15. All right, in the Theo. You know, not really a Theo. These Theos are bad. I should have reset my vols. Meanwhile, the August, well, my 160s are worth about, you know, let's call it 235. And my 165s are worth, let's say, 80. All right, so what's 135 minus 80? $1.55. So now would I rather collect $1.15 with, you know, call it a week to go at the time I pulled this? Or would I rather collect $1.55 with a month to go? Which one has you think more advantage? You know, which one do you think is more advantageous a trade? Yeah. Now, are you really going to try and collect all of the premium on this if you know what you're doing? The weekly is the far better trade. All right, I'd rather get $1.15 for a week's worth of risk than $1.55 for the monthly. You know, this call spread, you know, on Monday's sell-off, I have to look. I'll be able to tell you in a second. So I think I pulled this Friday afternoon. I'm going to switch to my other screen. So this is my pricing system. And let me take a look here. So let's see what that was worth yesterday. This is SPX. So it was down 68 cents, and the call spread was already only, you know, at the close yesterday. This weekly call spread, I could have covered for about 80 cents in one day. All right, now it's back up above 160. You can see after hours. So here we are today. So it moved against me. And guess what? This call spread is still only worth about $1.05. I'm still up 10 cents on the spread. And that is because that decay is so rapid. So you absolutely, at the money stuff for premium collecting is so much better when you use weeklies. All right, now let's talk about some other edge in weeklies. All right. All right. The real edge in weekly options is strategic placement of the option trade. One can pinpoint where one wants to take long risk and where one wants to take short risk. All right. One can pinpoint and analyze event risk. All right. One value of weeklies is determining how much we think a stock might move on earnings. So here's Bed Bath & Beyond. We like to call it Bloodbath. So we call it Bloodbath & Beyond. Because when my wife goes there, my wallet takes a bloodbath. And she doesn't appreciate that joke. So this is like the day before earnings. And what you can see is that this straddle is worth about $4.20. So the market is expecting about a 5.5% move. That is a huge advantage of weekly options. All right. Now, Tesla has earnings next week. So this is a new trade that I looked at, and I actually did this a week ago and took it off. I did a second bear Tesla trade that you're going to see. That I'm not going to show you, excuse me. All right. I can also see, just by looking at the implied volatility, what week earnings are. So now here's a trade I use with weeklies all the time. I use that earnings to my advantage. Now, what's one thing we know about an earnings month? What is one thing we know about an earnings month or week? About the premium. Does the premium decay slower or faster than a normal weekly? Much, much slower. So I want to use a play. No, it's slower until the earnings come out. Then it's much faster. All right. So I want to play a trade in Tesla and then use earnings to my advantage. So Tesla, after tanking a couple of weeks ago, had a nice little recovery. All right. The stock moved up and down some, and I wanted to fade the move. I can use strategic weekly calendars to place a bearish trade while reducing my risk associated with the bearish position. Now, in this case, I don't mind the decay being a little different because I'm actually using the option just to defray cost. So I buy the announcement weekly. So I buy that August put because that decay is going to really hold up. All right. I sell a near-term put that is just out of the money as well. All right. Thus, I'm harnessing that decay. I'm defraying my cost, and I'm strategically buying a much firmer weekly option. And I'm getting short Tesla exposure. All right. I end up with a cheap put that I can turn into a new calendar or a new diagonal. So here is the order ticket from a week ago Friday. And it was at the 260 strike. Tesla at the time, you can see here's where it was. Up around 272. And you can see I paid about $6.05 for this spread. You can see over the week, it dropped a little bit. I think it ends around 265. So, it gives up $7. And look at how my little weekly trade performs. All right, the implied volatility of this put really holds up, even increases. And my July 24, my regular 260, goes out worthless. All right, this trade, a trade like this really works to my advantage in that I set the anchor and I get the decay. And this is kind of what my risks look like. Other uses for weekly options. The wheel, I love it for butterflies. At the money flies and weeklies are the best. All right. Standard calendars and double calendars. Directional calendars. And again, it's not good for iron condors. So now the final piece that I wanted to quickly discuss was the VIX weekly futures they just listed. So I don't know if you guys are VIX futures traders. I follow them closely, but they just started listing these. Now the volume is not there yet, and they have not been listed by like Interactive Brokers and TD yet, but they will, and they are going to trade. And the near-term VIX future is going to be the closest thing that you'll ever see to tracking VIX itself. These just listed last week. I think they're going to take off. They already are doing better than most other VIX launches. So in summary, decay is more nuanced than many people realize. Weeklies can be good for credit spreads. Weekly value is in strategic placement, and weeklies are great to finance directional opinions. So now here is my offer. All right, I have a good follow-up course called Mastering Debit and Credit Spreads, Trading Debit Credit Spreads for Maximum Profit. You go to optionpit.com/option-income, and this class is 45 minutes, so call it 10 minutes longer than this class. All right, and I'm going to teach you a lot of things that you need to know about debit and credit spreads. Mastering buying versus selling, how to execute credit and debit spreads with precision, how to extract more dollars from the market on every trade, how to pick the right strikes to buy and the right strikes to sell. And this is open to the first 200 traders. Go to optionpit.com/option-income. Now, why would I give it to you for $12? I'm hoping you take it, you learn something, and you buy something else from me. Quite honestly. All right, now, any questions? Did we learn something? Well, I'm your guy if you need more education. You can email me, mark@optionpit.com, or you can call me. You see the number there, and I'll call you tomorrow, or I'll respond usually within 12 hours. Plus, you're named after my favorite captain of the Enterprise. Are you going over the same stuff in the next class? No, I don't repeat myself. I always put together good content. Everything I put out there will have something new and actionable for you. Will I talk weeklies? I believe so. Link to the replay, I'll email it out tomorrow. You can probably already find it on, if you want, there is an older copy of this already posted at this site that was associated with a 3-hour course we sold in May. That's available for replay if you're really interested in weeklies. It's a little more expensive. But if you take the $12 thing and you think that's good, then you can buy that weekly thing and you'll be happy. All right. Any other questions? optionpit.com/option-income. All right. See, look at that. 40 minutes flat. When is the class held? It's a recording. So it's on demand. See what somebody can do in 40 minutes flat? Pretty awesome, right? Now everybody go have a glass of wine. Or if you don't drink wine, have a nice club soda with lime in it. All right. Have a good evening. Or a Seagram's Golden Wine Cooler. Or Seagram 7. All right. Have a great day, guys. Good night.